If silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt, and in a place where it can't be taken from you.
I still think silver lags a little in that, it'll at times run a little bit ahead of gold, but gold is still charging ahead. And I didn't think I'd live long enough to say this, but I really believe that 5,000 now is only a question of when, not if.
Gold and silver are entering a critical stage of the bull market as physical demand surges and global inventories dwindle. COMEX is witnessing significant deliveries, even in off months, with silver now showing simultaneous strain in both London and Shanghai. Industrial demand is accelerating, especially for silver, where any shortage immediately affects technology, energy, and defense supply chains. These conditions reveal a market where buyers no longer care about the price, they care about securing ounces. At the same time, overnight funding tensions and weakening credit liquidity echo the same stress signals seen before previous systemic breaks. If either gold or silver experiences a delivery failure, the financial system closes around investors, locking capital inside banks and brokers. In a world built entirely on credit, that risk is becoming too large to ignore. Bill Holter, a leading voice on systemic financial risk, warns that today's fragile credit and banking structures make a failure to deliver event far more dangerous than most realize. Peter Grandich, a veteran precious metal strategist, highlights how persistent supply tightness, institutional accumulation, and global monetary debasement position gold and silver for strong long-term appreciation. The world is shifting quietly toward real settlement, and precious metals remain firmly at the center of that transition. For investors tracking silver tightness, gold's monetary evolution, and the broader precious metals cycle, the setup remains more bullish than ever. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We're back to the high levels, not quite on gold, but yes, on silver. But neither silver nor gold are as overbought as they were 3 weeks ago. So they worked off some of the overbought. The paper sales did not work in yes, they got a short-term pullback, but it didn't work like it had in the past, where you get a smash and, it's another month, 2 months, 3 months before those numbers are revisited. This was amazing that the metals have, they pulled back basically to where they should have on charts, relieved the overbought, and here we are again, not as overbought as we were before. And in silver, well, in both, in gold and silver, you're starting to see some global price insensitivity. They don't care about the price. They want the ounces. And thanks for having me on. The paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer, I think, you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical, because they have to deliver real physical that does not exist to be delivered. The market is, the bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. If gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. Every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt. Right. Well, going back to visit the late 2019 episode, that was just before COVID. And the repo rates spiked to 10%, and that the Fed was having to put $100+ billion into that market every single night so it could clear. Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID. And it allowed central banks all over the world to flood the markets with liquidity. Problem solved. Not solved, but the can was kicked down the road. Here we are again. We're nowhere near where we were in October of 2019, but the overnight rates are starting to move higher again. It's a concern and should be watched. Again, everything, whether it be the real economy, production, consumption, transit, and also the financial world, the financial economy, everything runs on credit. If credit gets disrupted or credit ceases anywhere, it'll be a shock that will, it'll shut the whole system down. We have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long-term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably who knows, $2 million an ounce. Just pick a number, but it's going to be super high. And there's always some risk. I think the risk will be greater as the prices go higher. And I would simply say, either call me or call you. We clear our business through Miles Franklin, and Miles Franklin's been in business over 30 years and never had, they have never delivered a counterfeit coin, as far as I know, has never delivered one counterfeit coin to a customer. That if you go through a reputable broker, their business is done. If they send you a counterfeit gold eagle or gold bar or silver or whatever, if they send counterfeit to you, their business is done because then their reputation, their word is broken. So I would just say, and do understand that any time metal is shipped out, it's done 100% under camera, and the coins that they receive, other than coins directly from the U.S. Mint, it's my understanding that all coins are assayed and proven to be real when they come in before they go back out. So if you use a reputable dealer, use us, Miles Franklin, you're going to get the real deal. I'm watching silver in particular, COMEX silver. Also, we're seeing now that silver, silver's obviously tight in London, but it's also becoming tight in Shanghai. This is a global phenomenon. This is not, oh, there's plenty of silver, but it's in the wrong place. No, there's not plenty of silver. And what I'm watching as far as COMEX is concerned, November is strictly a non-delivery month. And the amount of contracts being added on a daily basis for November delivery is astounding. December, on the other hand, is a big delivery month. And I question, can they deliver 60, 70, 100 million ounces for the month of December? I don't know. It just looks to me like the failure to deliver, we're walking on a knife's edge at this point.
Gold and silver continue to advance as the physical market increasingly supplants paper pricing, with demand shifting toward the east and global inventories tightening. Momentum is building as central banks remain steady net buyers, providing a structural foundation that supports higher prices. Recent washouts have shown strong physical buying stepping in immediately, confirming that weakness is being treated as an opportunity rather than a reversal. With gold holding firm above key support levels and silver showing intermittent bursts of leadership, the broader trend remains unmistakably upward. Debt expansion, rising interest burdens, and the growing recognition that traditional financial assets are vulnerable are pushing more capital toward precious metals. Structural deficits, demographic pressures, and weakening Western economies add fuel to the long-term case. In this environment, capital preservation becomes as important as growth, and metals continue to stand out as reliable anchors amid global instability. Let's get back to the interview.
Basically, the gold market has moved to the Far East and particularly out of China and all. And the physical market now dominates the paper market. And so that has been a major, major plus. And then, of course, the question I think one should ask is there anything that can end the bull market, not just a correction? The only thing I see on that can possibly do that is central bankers go from major buyers to net sellers. And there's not even a hint of that. So all systems are go other than periodical corrections or consolidations. I still think silver lags a little in that, it'll at times run a little bit ahead of gold, but gold is still charging ahead. And I didn't think I'd live long enough to say this, but I really believe that 5,000 now is only a question of when, not if. People are trying to find reasons for gold not to continue higher. So let me discuss that with you, if I may, Dave.
Yeah.
So when I entered the brokerage business, when most people that are investment advisors now weren't even born, the Dow had gone only up between 700 and 1,000 for 13 years. In fact, in the early 1980s, a famous Business Week cover page said equities are dead. Basically, everybody on Wall Street felt that because of all sorts of problems back then, there was just no way that equities can go much higher. And then a young man came out of Gainesville, Georgia, that no one heard of, with a process no one heard of called the Elliott wave theory, named Robert Prechter Jr., and predicted 3,600 on the Dow. And he was ridiculed. Within a few years, he proved pretty well correct, and then some. And of course, it went much higher. Now, I'm not saying that gold's going to 47,000 too over the next 30 or 40 years. What I'm just saying is there's nothing out there to say that gold can't go higher. The problem is that it's still not widely accepted in the general financial community in North America. Now, that's different when you go to Asia. But here in North America, we're still seeing most people caught in the world of financial assets and stocks and bonds. So then the question I ask is, well, if gold could do that with all that going against it, and now we're seeing cracks where they're starting to come over to it, where could it go? If you want to take history, the typical history has been, we've seen gold become as much as 4 or 5% of the typical portfolio. It's still believed less than 2% at this point in time. So if you want to use history, we can also say the history says it could still double. Now, I'm not saying it's doubling, but what I'm just saying is I think it's a mistake to think it has to go back down simply because it always did something before. Remember, gold was a paper trading vehicle when you looked at that 2010 and 11. Now it's a physical market. See, the Bitcoin argument will go, hey, listen, there's only so many. If more people keep buying it, it should go up. Now that's questionable why it isn't going up despite all that. But the same can hold true for the gold market. If more people are going to be buying it than before, then the pressure is going to be to the upside, not to the downside. Well, a melt up in terms of the stock market, which felt it could run towards the end of the year,
Oh,
but
yes.
going into 2026, I think it's going to be a totally different story. But again, this parabolic move, and you were right, that's a basic straight line, and there's concern. But look at the corrective nature that we just saw in the last couple of weeks. We had one big washout day. It was $250 down. We tested a couple of times a little bit under 4,000, and physical buying turned the market, not futures trading. And that is the signal of how much people want to buy if there's any weakness in gold at all. That's why I can't make an argument for it much lower, because there's too many underlying strength demand right now for it. I really believe over the next couple of years, Dave, it's not how much you're going to make, it's how much you don't lose, which is going to separate the winners from the losers. So my focus is going to be on capital preservation, not appreciation. You're right. We've had some great years. I shared in it. This is the best 5 years and best single year I had. But to think that's going to happen next year, I think is going to be a mistake. And that's why I want to err on the side of caution. If it eats away at it, and if I earn 4 and inflation 6 and a 2% loss versus a 20, 30, or 40% loss in stocks, I'll deal with that. And like I said, I think there's a lot of other things that are occurring, including the fact that we don't know how we're going to get to this 50 trillion in debt. We just had the fastest period of time where our debt increased by $1 trillion. I have to tell you this, David, we're at 38 trillion. When I started in the business, honestly, on the life of my child, I didn't know what a trillion was. I didn't know how to compute it. Nothing was considered a trillion. Now we have 38 trillion heading for 50 trillion. Dave, at 50 trillion, at 5% interest, we're going to have a 2.5 trillion interest payment. We've never even made more than less than 6 trillion as a country. And now, by the way, Trump, shockingly, seriously, I mean this, is now following a Biden precedent and wants to forgive certain student loans. That's all good. Here's the problem with that. Student loans are the single largest asset that the United States has right now, 27%. So that income that we're going to lose by forgiving those loans has to be made up somewhere. What are they going to do? They're going to tax us more in order to make up for it. And here's the other problem with that, David, and you'll be talking about it someday if they go that way. Where do you stop? What happens when people start having serious problems with mortgages, car loans, consumer loans, all these other things? We're heading here in the United States in a wrong direction. I know that upsets, and I'll get the emails from the MAGA people, and he's going to make America great and all that again and all. There's too many underlying issues. Not his fault. Many have come from past administrations that are still getting worse, not better. So that's why I am taking such a cautious, especially after this blessing this year of having these type of results, that I really think for the next couple of years going forward, people should be much more cautious, especially if they have gray hair or no hair. So China has, according to key generals of the United States this year, surpassed us militarily on many fronts. China, if you remember at the beginning of the administration, along with the BRICS, Trump quotedly said, I'm going to break their kneecaps. China managed to move around and get their exports going to other places in the country. Their economy's lifting, not declining. And what did the United States get out of all of that? Now he says, oh, well, we're taking in, we're doing great and all. The tariffs are taxes. He can call it whatever he wants, whatever and all. It was still paid by somebody on this side more on the ocean than the other side of the ocean. And I just think the fluff and the hope that Trump had brought in and all, he blew it by taking a big stick into this trade war versus an olive branch. I think gold, silver, copper. Listen, the uranium stocks, they've gone
Yeah.
up tremendously a lot. But that perfect storm continues. People, the need for electrical power is great and it's going to continue and all. But I think where you invest in the world, if you said to me, Pete, I need some growth. Well, you know what? Look over in Asia. I love the Singapore market. I love the Chinese stock market. There are other areas, even like the Vietnamese market and all. But those are case by case. I don't like doing a cookie cutter for the whole world to be that regard. I'd avoid the western part of Europe. Like I said, I think the EU is in huge trouble. I think the United Kingdom and France, in particularly, are going to have huge, huge economic and social and political problems and all. So I think where you invest in the world is as important as what you invest in.
As global markets shift, gold and silver continue proving their strength against growing financial instability. Physical demand is rising faster than new supply, and the center of gravity has moved decisively toward the east, where real metal, not paper contracts, now sets the tone. Recent sell-offs were absorbed instantly, signaling that buyers view every dip as an opportunity rather than a warning. With debt levels surging, currencies weakening, and geopolitical tensions escalating, precious metals are assuming a more prominent monetary role. Investors focused on stability, preservation, and long-term positioning are increasingly turning toward metals as the only assets that stand outside the system. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.